Hi, welcome to Learn with Sri. This is the second video on leverages. In the previous one, um, we were talking about example 1 where we got introduced at a very high level to this topic leverages, but that example 1 was from a balance sheet perspective, and now in this video I'm going to be talking about example 2, which is going to be again an introduction to this topic leverages at a high level, but this is going to be from a P&L perspective. So now we are going to go for example 2, and this example 2 is going to be from P&L perspective. So let us take a simple example. Let us say we are talking about a coaching academy. We're talking about a coaching academy. Fine. Um, let's say we are talking about some particular year of operations. Let's say we're talking about one particular year of operations, and let's say 100 students enroll. 100 students. ₹1,000 is the fees per student. So with these two in place, I can say that the revenue for the tuition academy is going to be 1 lakh, right? So this year the revenue for the tuition academy is going to be 1 lakh. Let's assume just one expense for the one item of cost for the coaching academy. Let's say that's the tutor's fees. The tutor's fees is rupees 80,000. Let's say tutor's fees is rupees 80,000. There will generally be several items of expenses, lot of cost, but let's just assume one item for our discussion here in this simple example, which is going to be tutor's fees, which is 80,000, amount that you pay, amount that the coaching academy would pay to the teacher who's going to handle the courses. From this, I will get the profit for this year, and I'm going to define profit as revenue minus cost, and that's going to be 20,000 in this example. 1 lakh minus 80,000, 20,000 in this example. Great. Let us say these are the base facts of this example. Now I'm going to take two scenarios. I'm going to take two scenarios. Scenario 1 and scenario 2, we are talking about the next year of operations. This, let's say this was 1 year of operations, and we are talking about the next year of operations, and for the next year we are taking two scenarios, scenario 1 and scenario 2. Scenario 1, let us assume 200 students have enrolled, and scenario 2, let us assume only 50 students have enrolled. Scenario 2, only 50 students have enrolled. So in the first year of operations, we had 100 students enroll, and in the second year, which is the next year of operations, we take two scenarios. First scenario, 200 students. Second scenario, only 50 students have uh, enrolled. Let's say that the teacher is offered a fixed salary of 80,000. Let's say this is a fixed salary. This is a fixed salary. Great. Now, the profit as of now is 20,000. I'm going to go to scenario 1, and in scenario 1, let us see what is going to be the profit. Scenario 1. The revenue is going to be 2 lakhs. This is because 200 students pay ₹1,000. I mean, we are not assuming the fees would change. I'm just going to keep the fees constant. So revenue is going to be 2 lakhs, and tutor fees, which is the cost, tutor fees, that is going to be still 80,000. That is going to be still 80,000. So I subtract that. Now I get my profit of 1,60,000. I get my profit of 1,60,000. Let us see what has happened. If I look at revenue, revenue went up from 1 lakh to 2 lakhs. Basically, this is a 100% increase in revenue. We're talking about a 100% increase in revenue. Let us look at what has happened to profit. When I talk about what has happened to profit, now I would say profit has gone up from 20,000 to 1.6 lakhs, 1,60,000. So if I see what is the percentage increase, that's going to be 700 percentage. That's going to be 700 percentage. Now how do I get the 700 percentage? Well, simple calculation. 160,000, 1,60,000 minus 20,000 divided by 20,000 into 100. So this gives me 700 percentage. So let's see what has happened. Revenue increased by 100 percentage, but our profit increased by 700 percentage. So here again I can see this magnified impact coming back. You can see this magnified impact. Again, if you look at this, there was a trigger. What was the trigger? Increase in revenue, right? See, basically what happened was there was an increase in the students' enrollment. So that's what caused the revenue to increase. Let's assume that the revenue increase is the trigger. There was an increase in revenue. That was the trigger. But if you look at the impact of that increase in revenue, you can see that on profit, but profit has not increased just by 100%. Profit has increased by 700%. So you can see this magnified impact here. So you can see this magnified impact. When revenue increases by 100%, you can see profit increasing by 700%. Now, why did this happen? Here in this example, what caused this magnified impact? I would say the tutor's fees. The tutor's fees is what caused this magnified impact, because this tutor's fees is fixed. Here, the tutor's fees is fixed. So in the previous video, we discussed anything that has a fixed element or is of a fixed nature has the effect of contributing to this magnified impact. Here in this example, it is this tutor's fees. When the revenue increased from 1 lakh to 2 lakhs, the tutor fees never changed. The tutor fees still remained to be 80,000, because we assumed in our example that the tutor was paid a fixed salary of 80,000 rupees per year. So what happened here was this number never changed, but revenue alone doubled. Revenue doubled. It went up by 100%, but this didn't change. So here we can see that the cost was a fixed cost. The cost was a fixed cost. The cost did not change. So because there was this fixed element here, you can see the magnified impact on profit. You can see the magnified impact on profit. So here also in our discussion, there was this fixed element, which is the fixed cost in this example, which contributed to the magnified impact. Okay? This was scenario 1. I'm going to go to scenario 2. I'm going to go to scenario 2. In scenario 2, we said we have only 50 students enrolling in the next year. This is the second scenario. So if that is the case, my revenue is going to be 50,000. 50 students into 1,000 rupees, 50,000. My tutor fees is going to be 80,000. My tutor fees is going to be 80,000. So I'm going to have a profit of negative 30,000. I'm going to have a profit of negative 30,000. What is this negative 30,000? Basically, it is a loss. Negative profit, this is a loss. So let us see what has happened. Revenue from 1 lakh became 50,000, 50k. From 1 lakh became 50,000. So this is going to be a drop of 50%. So revenue has dropped by 50%. What has happened to profit? If you look at profit earlier was 20,000. Now 20,000 has dropped to minus 30,000 because it's a loss. So you can see that this is a 250% drop. Now how do I say 250%? Because it is 20 to minus 30 divided by 20. So basically I can say it is 20 minus 30 divided by 20, which is 50 by 20 into 100. So that gives us 250 percentage. So you will see the magnified impact again. And we have discussed several times that this magnified impact is what we call as the leverage effect. It's what we call as the leverage effect. Here again, why did this happen? Because of the tutor fees, which was the fixed element here. It is a fixed cost. It did not change. Even though the revenue dropped, this number did not change. So you can see the impact of the trigger on the profit to be magnified because there was something in between which was fixed. So discussing this magnified impact from a P&L perspective also tells us that what is important for this magnified impact to be seen is a fixed item. Since we are talking about the P&L, we are talking about things from a P&L perspective, we are talking about cost, and since we were talking in example 1 about since in example 1 we were talking about things from a balance sheet perspective, we were talking about sources of finance, but here it's P&L, so we are talking about items of cost, right? So whatever it is, this fixed remains the contributor to the magnified impact, which is the leverage effect. In the same example, had the tutor's fee not been a fixed salary, let's say instead of 80,000 rupees per year, let us say the tutor was paid, let's say the tutor fees was negotiated as 80% of every student fee. 80% of every student fee. Let's say this was the arrangement. Instead of a fixed salary, let's say this was the salary. I'll probably call this as a variable salary because the tutor's salary now depends on the student enrollment. Let's see what happens. If you have 100 students, then the revenue is going to be 1 lakh. The cost, which is the tutor salary, is going to be 80% of this, which is going to be 80,000. So you're going to have profit of 20,000. No problem. This is the base case. Let's look very quickly at what happens if we look at scenario 1 and then if we look at scenario 2. Scenario 1, my revenue is going to be 2 lakhs because we are talking about 200 students here. The cost is also going to be 80% of this. 200 students, each pays 1,000 rupees and the tutor gets 80% of that. So the cost is going to be 1,60,000. So if you look at the profit is 40,000. The profit is 40,000. Let me go to scenario 2. Scenario 2 is where we are talking only about 50 students. We are talking only about 50 students. If you look at revenue, you're going to be having 50,000 as the revenue. If you look at cost, you're going to be having 80% of this, which is 40,000. But the calculation would go like this. 50 students, each student pays 1,000 rupees. So you collect 50,000, out of which 80% belongs to the teacher. So it is 80% here. So you have profit, and the profit is, let us say, the profit is 10,000. Scenario 1 and scenario 2, let's see what happened. Revenue increased from 1 lakh to 2 lakhs, and that is an increase of 100%. If you look at profit increased from 20,000 to 40,000. That's also 100% increase. You can see both are 100% here, and there is no magnified impact. Coming to the second scenario, if I talk about revenue, revenue drops from 1 lakh to 50,000. So that is a 50% drop. And if you come to profit here, profit drops from 20,000 to 10,000. And that is also 50% drop. Look at both the scenarios. The trigger was 100% here and the impact was also 100%. Trigger was 50% here and the impact was also 50%. In both cases, there is no magnified impact seen at all. There is no magnified impact seen at all. Why? Why are we not seeing magnified impact? Because there is no fixed element in the cost. The cost is not fixed, the cost is only variable. So this again clearly tells us that absence of a fixed element will say that there is going to be absence of the magnified impact. Presence of the fixed element will say that there is going to be presence of the magnified impact, and the magnified impact has a direct relationship with the proportion of the fixed element being there. That is the conclusion that I will draw. So if I put example 1 and example 2 both together, discussing things from a balance sheet perspective and also looking at the same thing from a P&L perspective, the conclusion I draw is the same. The conclusion I draw is the same, and that is about the fixed element being very important for the magnified impact, and this magnified impact is what we also call as the leverage effect. I've told this many times, but I keep repeating this so that this needs to get into your head, and it is this that we are going to mainly focus about in this topic. Okay, yeah. So this is it for this video, and in the next video I'm going to start my problem solving. So thank you for watching this video. Please do subscribe to my YouTube channel Learn with Sri, and I hope you enjoy the learning experience. Thank you.